Hello everyone, and thank you for attending today's webinar. Today's presenter is Joe Burgoyne, Director of the Options Industry Council. The presentation will begin momentarily and will be recorded and accessible after today's meeting. We'll send out email link to all attendees. If you have any questions, please use the Ask a Question box on your screen. Thank you. Okay, we can go ahead and turn it over to Joe now. Joe, go ahead.
All right, Joe, thank you so much, and welcome everybody. Thanks to Schaeffer for the opportunity to talk about options today. Options are, I think, an extraordinarily versatile financial tool, and the title of today's presentation, Option Spreads for Bulls, Bears, and Everybody in Between, almost sounds too good to be true, but we're going to go through some different areas and some takeaways before we get started. Hopefully you'll have a clear understanding of the difference between historic and implied volatility. That goes a long way towards constructing these option spreads and the value of these option spreads. After we get through historic and implied volatility, we'll start talking about straddles and strangles, straightforward option strategies that can allow the bull and the bear to both make money. And then if we have time, we'll go to a couple different credit spreads. So again, thanks to Schaeffer's for the opportunity, and we should get started. Let's see. I am trying to move the slides here, Joe. I don't know. Okay, there we go. A little hesitation. So most of you may know that options do involve risk, and the industry puts out a document called Characteristics and Risks of Standardized Options. You can get that through your broker or from us at the Options Clearing Corporation. Many of you may not be familiar with the OIC. The Options Industry Council is the educational arm of the options industry. We were founded in 1992, and we've been out basically trying to educate investors on the benefits and risks of the listed options product. That's what we're all about. We're unbiased. We're not trying to sell anything. We just want you, the informed investor, to be aware of the different complexities, benefits, and risks of options. We are funded by the OCC, and it's the OCC, the Options Clearing Corporation, that really sets the listed options market apart. The OCC guarantees the other side of every trade that takes place, and has been doing so since the inception of the industry back in 1973. So we are funded by the various options exchanges along with the OCC starting in 2018. The funding for the Options Industry Council will come exclusively from the OCC. In the options universe, we now have 5 parent companies. There are 15 total option exchanges, but the parent companies are the CBOE, NASDAQ, BOX, MIAX, and the New York Stock Exchange. I'm sure you're familiar with CBOE, NASDAQ, and New York. MIAX, an electronic exchange based in Princeton, New Jersey, and the BOX, another electronic exchange that is based in Chicago. Here's one of my favorite slides. Actually, the bottom left-hand corner, you can see 1973. That's when the industry started. April of 73, there was one exchange, the CBOE, Chicago Board Options Exchange. First day in April of 73, 16 companies had options listed on them. And you may not know that those options only included calls. The SEC did not allow for the trading of puts until 1977. So for the first 4 years of the industry, it was exclusively the call side. As I say, we started with 16 companies back in 73, and now in 2017, we're up over 4,400 different companies. Individual companies, ETFs, and indexes comprise that number. The reason I like this slide so much is because, it basically is a snapshot of an industry that started from nothing, that has grown to be, incredibly resilient and liquid over the last, 10, 15 years. I spent 20 plus years on the floor as an option specialist in Philadelphia in the 80s and 90s and into the early 2000s. And the reason option volume expanded so dramatically once we get into the 2000s, I mean, if you remember, that was the tech bubble. But for the industry, we got electronic access to the markets. An exchange which is now owned by NASDAQ called the ISE was the first electronic exchange that gave investors the ability to click a button and get a report shortly thereafter, instead of the process of, an order having to touch hands with a handful of different folks. So we had electronic access to the market starting in 2000, coupled with each underlying that the exchanges listed options on began to be traded on all the exchanges. And at that time, there were 5 exchanges. So we had electronic access coupled with 5 marketplaces rather than 1. That narrowed bid-offer spreads, and you can see option volume went from just over 500 million contracts annually to within 10 years, over 4 billion contracts. And when you think about it, the climate we're in with such extraordinary low volatility, it's pretty remarkable that the options industry has sustained its average daily volume in the 16 to 17 million contract range despite this low volatility. So that's a little bit about the history of the business. This slide takes us through 2016, 2017. Again, we're on pace to exceed 4 billion contracts, which is about that 16.5 million contracts a day traded. So let's get into the core of the presentation. Just a couple quick comments on option premium, because again, we're talking about straddles and strangles as we get, towards the strategy side of our presentation. So, we're talking about positions that basically own a call and a put. So option premium is key to understanding. And, to me, there's a lot of misconception about options out there. They're very confusing. They're complex. I would give you, that they can be confusing, but that's really when you get started. The concepts in options are straightforward and clear. It takes a little homework, yes. We do have our own language, which takes a little getting used to, but really the concepts are clear, and I hope I'll prove that over the next 45 minutes or so. So option premiums, all right? Every contract has a price. That price consists of potentially 2 things. Intrinsic value, which is an in-the-money amount. Okay, take a $45 stock. If you've got a 40 call and the stock is 45, the value of that call is going to be at least $5, because what does the 40 call give you? It gives you the right to acquire stock at the strike price, 40. With the stock 45, there's $5 of intrinsic or in-the-money amount, coupled with whatever time premium is on top of that. So that's an in-the-money option. Not all options have in-the-money value. I mean, many options are either at the money or out of the money. And, I hope you understand that aspect. If not, we can go over that in some detail, maybe at a later date. But the point here is option premiums may have intrinsic value if they're in the money. But on top of that, options have time premium. And if tomorrow's expiration, clearly there's not going to be a lot of time premium. But most options have, a fair amount of time. Many of them, can go out a year and a half, 2 years plus in time. So it's that time premium that is really the key component of the option price. What factors go into an option price? Straightforward, and I'll just quickly mention, we got the underlying stock price, the all-important strike price. Do know the difference. Don't get confused between the price of the underlying and then the strike price. Timed expiration, volatility, and then interest rates and dividends, if that's basically a dividend-paying stock or index. Now, among these factors, the ones that impact time value are volatility, interest rates, and dividends. But, volatility. And at the start, I talked about historic and implied volatility. We're going to get into that very shortly. As I said, timed expiration is a known factor. The reason this implied volatility aspect that really defines option premiums is important is because that's kind of an unpredictable. It's a bit of an unknown. To me, it's the great, enjoyable, and fun part of the option space. So let's get into defining historic and implied volatility. Let's start with volatility. Volatility is not about a one-way move, up or down. Volatility is about fluctuation. The market's moving up and down. As I mentioned, and those of us who pay attention to the markets know, we've had historically low volatility this year. I mean, the market has basically gone, for the most part, sideways, but really straight up. There haven't been that many. The corrections have been sideways, not down for the most part. So that's why volatility has been so low, because there just hasn't been any up and down fluctuation. Essentially, it's been one way. Getting back to the core concepts, simple ideas. High volatility versus low volatility. A high volatility stock is one that moves all over the place. A low volatility stock more likely to be a dividend paying stock. Sort of a flatliner without a lot of personality. Other aspects of the market and volatility to at least be aware of. Different sectors. Start talking about the biotech sector, you're talking about big time option premiums because of the potential, for certain things being approved, not approved, problems with tests. Technology at times can be a high-flying sector. The market moves in waves, really, I think, and that's just the flow of capital going from one sector to the next. Common sense. Just have an idea of whether the sector that your individual issues, ETFs or indexes are in, are high or low volatility sectors, and that way, you'll get a better comfort level with the premium levels of the stocks. So historic volatility, or realized volatility, some folks call it, is basically a statistic. It's a fact about how much the underlying stock, index, or ETF has moved in the past. So it's a calculated measure. So there's nothing unpredictable about it. I like to call it the personality of a stock. Is it a high flyer? Is it a flat liner? Is it somewhere in between? But that historic volatility measurement will tell you that. One of the questions, we ask ourselves about volatility, okay, the stock has been a mid-tier mover. Is that going to continue in the past? Well, you don't know that with historic volatility. Historic volatility is basically a snapshot into the rearview mirror. Where do we find historic volatility? You can find it at your brokerage website. Certainly, our website at the OIC is optionseducation.org. We've got a plethora of things like historic volatility. I think in some later slides I'll show you the vol charts, but you could easily get lost at optionseducation.org with all the different things that we offer there. One thing you want to be aware of, historic vol can be calculated on a weekly, daily basis, annualized. Do be aware of which time frame the historic volatility is being calculated on. Speaking of volatility charts, and as an old floor trader, I basically, as I mentioned earlier, think that implied volatility is what it's all about in the option space because it defines the level of premium, which of course is the price that we either have to pay or collect if we're an option seller. On our website and many others, you can find charts like this. That dark line is the 30-day historic volatility level. And on top of that, the green line measures the implied volatility level. So you can see generally, and this particular representation is the implied, that green line, is below the historic vol a little bit more than, I find typically the implied volatility levels are slightly above historic, but that moves over time. Again, the fun aspect of the option space, that implied volatility level is dynamic. So it sometimes moves rather abruptly. Volatility is option risk. Remember, a stock's future volatility is seen through the implied volatility that options represent, and it'll give you a sense as an option buyer what the likelihood of potentially exercising your option might be, or more importantly, I think, because you don't have control as an option seller, how likely it is that you may be assigned. So that's really what this whole idea of historic volatility gives you. It gives you a sense of how far the market has moved in the past. Back to this, very straightforward idea of higher versus lower volatility. Obviously, higher volatility, the option premiums are going to be more expensive, and the lower volatility stocks, the premiums will be less expensive. So, the buyers will pay less for the lower vol stocks, but, conversely, the sellers collect less as well. And that's why, going back to those vol charts and just getting a sense, just like looking at any underlying chart of a stock index or ETF, you get a sense for, is that underlying, on the low side? Has it run away? Is it above its moving averages? Or is it kind of at a mid-tier point? You can formulate, just by looking at those vol charts, whether the premium levels, and again, that's what the implied volatility represents, the level of premiums, whether they are, on the low end, midpoint, or maybe at all-time highs. A subtlety, when we talk about option premiums, okay, stock volatility, okay, the amount that the stock moves around, that can increase without the implieds, okay, the premiums increasing. And there'll be a slide under the implied volatilities a little bit later, when the implieds increase, that suggests that the premiums do in fact expand. Okay, so you can have the underlying, move around a bit more than it has in the past, and potentially the option premiums won't expand. It is, more common that once premium picks up, the premiums do expand though. So just a subtlety, just because the stock is starting to move around a little bit more, doesn't mean that the option premiums have to increase at that same magnitude. I mentioned early on, only time value is affected by volatility levels, and that's why having some understanding of those volatility levels through the implied vol charts, I think is well worth your while. Let's talk briefly about standard deviation. Again, we mentioned volatility is a measure of stock fluctuation. Well, statistically, and we're not going to get into heavy math here, and you don't need heavy math, to really do very, very well in the option space. But, just so we talk the language a little bit of how this all works, volatility is the annualized standard deviation of a stock's daily price range, all right? And so that's just something to be aware of. That standard deviation is going to give you an idea of how wide of a range that stock will move, on an annualized basis. If we're calculating it that way, again, you can calculate it on a daily, weekly, or monthly basis as well. And it's just a question of how widely dispersed that those stock movements may be. The thing that, one of the areas that I think allows this whole idea of the math side, the standard deviation side, to play into the option space is allowing those standard deviations on your underlying to help define price levels. And with those price levels, it may give you the confidence then to initiate particular option strategies around those price levels. Specifically, maybe some of the vertical spreads that we'll talk about towards the end. But the general rule of stacks, all right, assuming you're working off a log normal distribution of stock prices, one standard deviation, happens about 68% of the time for, an underlying stock movement. So, 68% of the time, that stock's going to be in this particular range according to how we measure standard deviation. You get up to 2 standard deviations, you're 95% of the time, and then 3 standard deviations, it's 99% of the time. 2 and 3, you're almost talking outliers, all right? It's that one standard deviation move that I think personally can help as an area that can help define strike prices with some of the underlying should work. So if you haven't done that before, maybe through the various programs that the brokerage houses offer, you may check what a typical standard deviation move is for your underlying, maybe over a monthly period and then a yearly period. See what price points you come up with versus the current price of the underlying, and see if maybe then a particular option strategy would work around that defined one standard deviation move from the current stock price. So that's historic volatility. It's a measure of how much the stock has moved in the past. Again, I call it the personality of the underlying. Is it a high flyer, or is it a slow kind of high-paying dividend stock? That's historic vol. Let's talk implied vol, and I've referenced it a little bit. It is the market's expectation for how much the underlying is going to move in the future. That's what options do. We're calling this implied volatility. The marketplace is implying how much your favorite stock, indexes, or ETFs are going to move over the next week, month, year, whatever calculation you're using. So implied volatility, unlike historic volatility, which is behind us, implied volatility is about the future. And that's only if options have implied volatility. It's not the case with historic volatility. So again, I referenced how important I think implied volatility is, and actually I think it's where, to me, the fun comes in the option space, because implieds, they can flatline. That implied vol chart can just go sideways, on some of these high dividend stocks. So, you're not going to get much of a vig in terms of the premium movements in those stocks generally. But in some of the more volatile stocks, and I'm not talking about, the crazy stocks. I'm talking about just your day-to-day stocks with nice natural movement. Sometimes those implied vols, so the premium levels, they can change, lightning quick. And you can never be sure exactly why. Sometimes rumors start. We know we have earnings cycles every 3 months, so 4 times a year. Typically, option premiums will expand going into earnings announcements because of the potential for the unexpected. So, that you can kind of count on. But, things like fundamental news in the marketplace, fundamental news on an underlying stock, an unexpected corporate announcement, all these things. And I'm sure those of you on today, many of you are already in the option space. You've seen volatility, pop, sometimes for no apparent reason, and other times, for obvious reasons. Sometimes, depending on the amount of liquidity in the underlying and in the options market, if the liquidity is not great, 1 or 2 or 3 large option orders, call buyers or put buyers can move implied volatility levels. So it can be something as simple as a big call buyer that can change the implied vol levels for all the options on that underlying. So lots of reasons. I think what you want to be aware of, and we will get to this, with our straddle and strangle conversation is, what is your volatility position? Do you have an implied volatility position? I basically talked about the whole idea of implied versus historic. Implied is the forward look by the marketplace, how much the market expects that underlying to move going forward. Again, you can find the implieds at optionseducation.org or lots of different sites out there on the web. Subtleties in implied volatility. For those of you who may be new to the option space, consistent personality traits of implied volatility. As the strike prices move from in the money to out of the money, implied volatility will get lower. That's called market skew. That's just how the markets work. I was talking about the subtlety earlier. When historic volatility picks up, implied volatility or option premiums don't have to expand. I did also mention when implied volatility increases, without question, your option premiums will expand as well. So when implieds increase, like I showed on that one chart, historic versus implied, when the implieds expand, option premiums will expand. So take that to the next level. Common sense. If you're short options, no matter what the position, and the straddle and strangle position will be long positions in terms of net options. But if you're short, options, say, against your underlyings, and volatility goes up, that position is going against you. If you have straddles and strangles on where you are net long option positions, clearly those implied volatilities expanding is making you more money. So again, straightforward concepts, simple to understand. Is changing implied a good or a bad thing? It totally depends on whether you're net long options or net short options. There's some other subtleties depending on what strikes, but really it comes down to, if you're net long options in your option position and implied volatility or premiums are going up, you're making money, additional money, in addition, potentially to money on the delta. Just from a premium standpoint, if implieds go up and your long options, you're making additional money. If you are short options and implieds go up, you're definitely losing money. On the flip side, if you are net short options and implieds go down, which they do, and again, talking about earnings announcements, we've got them 4 times a year. Typically, after that earnings announcement comes out, option premiums or implied volatilities contract. So if you're lucky enough to be short options, typically on the premium side, you'll make money. But sometimes, that short option position, can hurt because of the delta, the amount of movement in the underlying versus the premium. So, be aware of those two distinctions. You've got options in place for delta movement, and then you've got the potential to make and lose money on the premium side as well. I think I asked the question earlier on the implied volatility side. Know if you have an implied volatility position. And the fact of the matter is, every time you put on an option position, you've got an implied volatility position. So if you are net long options, you're net long vol, implied volatility. And if you're net short options, you're net short vol. So just, something to be aware of. Let's see. Risk in the marketplace with regards to implied volatility. Typically, as the market drops, implied volatilities do expand, but I'm not sure if in our lifetime we're ever going to see the market drop again, so maybe we don't have to worry about that. Let's see. Yeah, just that last bullet point's worth repeating. multiple factors do impact implied volatility, whether it's overall general market psychology, whether it's an individual sector. Could be just something as simple as I said earlier, a big call order or a big put order, but that's not going to happen in, the S&P 500. That's going to be only in those issues that don't have a ton of liquidity in them. Being aware of implied levels, I've mentioned it more than a few times. There's that implied volatility level. So let's just kind of look at this kind of quickly. That black line is the historic volatility level. So you can see, it's a low volatility stock. Oftentimes it's moving in a 10 to 15% historic vol range over the course of, a year. So you can see that in August of this particular year, something happened where implieds picked up, really dramatically, more than double. And you can see that option premiums did the same thing. So what's kind of interesting to me is, we had a little hiccup or pickup in implied vols back in the March time period, but that would be June. And then, of course, September, if we're talking earnings cycles, we didn't get any kind of pickup in June. So my sense, and, just trying to read the tea leaves of this chart, this is far more than an earnings premium increase and implied volatility increase. Who knows what the story was, but, I think that something changed in the personality of this stock, and it went from a rather, low volatility stock to a stock that moved around quite a bit. And, this incorporates, you can see 1 year. It'd be interesting to kind of look at this on a 2-year basis to see if actually the personality of this stock did in fact change. But you can see the implied volatility levels generally mirror the historic vol, and it's worth being aware of those levels. And again, you can find them just by going to an implied volatility chart at optionseducation.org. I talked about the skew in the marketplace as the strike prices get further out of the money. Option implied volatility levels will decrease. Common sense, there are lots of option months. Of the 4,400 underlyings that we have, about 650 to 700 of them have actual weekly options listed. Those weekly options, will run up to 5 consecutive weeks. So we've got that time frame coupled with then months, and for maybe 30% of those 4,400, we've got leaps as well, where option prices are posted almost out 3 years. So from month to month, be aware of different option premium levels as well. As I stated earlier, typically those months where your earnings come out, you will get, as we get 2, 3, 4 weeks to option earnings announcements, option premiums will typically start to expand. This slide is a snapshot. When we hit up our option platforms, I think it's typically overwhelming with all the darn numbers we see, but I would urge you, try to take time. This all-important Vega number, I'm talking about, okay, in that one vol chart, vols went from 15 to 40. Okay, fine, but what the heck does that mean? You can quantify that through the Vega number, and you'll find that Vega number on your screen. This is a more expensive stock, so the Vega, it's probably the index. So the Vega is a larger number. We're talking 27 cents here. So if implied volatility went from 40 to 41 and nothing else changed, none of the other pricing components changed, the value of your option, let's say, again, went from implied vol went from 40 to 41, your option value would increase by 27 cents. Now it's a longer dated option. No, I'm not suggesting that every option has a Vega at 27 cents. You'll see that many of the Vega numbers are only 1, 2, 3, 4, or 5 cents for the shorter term options. But when those implieds, and that one chart showed implieds go from 15 to 40, you're talking about 25 cents. Even, if you're only talking a penny or two and those implieds move that dramatically, and that doesn't happen certainly all the time, but it happens in the marketplace where you'll get a 10 or 15% move in implied volatilities. It has a meaningful change in the value of your options, and you can quantify that through that Vega number on your platforms. That's, I hope, an important takeaway for you. Let's see, the whole idea of Vega, it's theoretical in nature. The implied vols, come from, the option calculations, but you don't really have to worry about that. That's all done behind you. What you need to be aware of, because each platform gives you a theoretical value, it's helpful to be aware of what that implied volatility component is when you see the theoretical value. So 99 out of 100 times, and I don't know how many of our listeners pay attention to that theoretical value number, that comes from your option platforms versus the bid-offer spread in the marketplace. But if that theoretical value is lower than the bid-offer spread of the option, 9 out of 10 times, that's because the implied volatility is too low in the calculation. That typically is what drives difference between a theoretical value and the bid-offer spread in the marketplace. And that bid-offer spread, that's what the option's worth. Theoretical value is fine, but to me it's just a guide. The bottom line is options are worth what the market is willing to pay for them. So it's bid-offer spread that defines what an option value is worth. So strategies that want implied up, we're going to get into this straddle and strangle. Back spreads are option strategies. Actually, I did a podcast yesterday on Why World of Options that talked about back spreads for about 20 minutes with a colleague. And back spreads are option strategies that are net long options. So that's why, again, any option strategy that's net long options, for the most part, is going to be a winner when implieds go up. And, when implieds go down, net short option positions is typically going to be a winner. Short straddles and strangles, that's a bear. And when I say it's a bear, that's a bear from a risk perspective, because net short option positions, first of all, you've got either unlimited or, substantial marketplace risk. That's number one. Plus, you got to put up a boatload of capital to cover those positions. So if you're going to be playing options from the short side, please be aware of the risks associated with those positions. Ratio spreads, unlike the back spread, which is net long options, the ratio spread is net short options. Sometimes folks call them front spreads, where you're long one strike price, but then you're short on a ratio additional options at a different strike. So again, and there are lots of tools out there, position simulators that will allow you to get a good understanding of the risk in a position, most importantly when the underlying moves. I mean, it can be one thing to know what your risk is at the point where the underlying is currently trading. More importantly, it's about potentially that unexpected move up or down 30% in the underlying. Find out what your option risk is at that point. So just a couple more closing ideas on this whole idea of historic and implied volatility, and then we'll talk strategies. Again, understand the ramifications of Vega. You can quantify Vega on your platform under that Vega number. If you have never used an implied volatility chart, maybe my approach has always been, I've got a half dozen, maybe 10 favorite stocks and ETFs, that I'm in. And so I know the implied vols. I'm not saying, you have to be an expert in this, but just have an idea whether the option premiums are, at a regular, normal level, on the low side or the high side, because every time you initiate an options position, you initiate an implied volatility position as well. That last bullet there, expect the unexpected. That's where knowing your risk up and down, with a big move in the underlying, that's where, doing your homework really makes a lot of sense. I mentioned earlier, thorough knowledge of math and stats, not important. I mentioned that whole idea of standard deviation because, picking a strike price and a month, I think is, really the challenge in options, what strike, what month, and you might be able to use that one standard deviation move for your underlying to help you define a strike price. The more you know about implied vol, I think, clearly the better because, to me, implied volatility is the options market because options have premiums. The premiums are intrinsic and time value. A lot of options don't have intrinsic value because they're not in the money. They're either at the money or out of the money. And so that time value is by and large defined by implied volatility. That's why it's so important. So I hope that has resonated a little bit. Let's talk long straddles and straddles. Okay, so that's going to be the buy side. What is a long straddle? Well, a straddle is where you buy a call and a put. Same underlying stock, importantly, same strike price, and also the same expiration month. So all of that is very important. And that's what comprises a straddle. Buying a call, buying a put, same underlying, same strike, same expiration. Why do you get into a position like a long straddle? Well, really two reasons. Most often people get into that because they're looking for a big play or a big move in the underlying stock index or ETF. That's usually why investors put on long straddles. Another pure play is it's a volatility play. You're buying calls and puts. Premiums go up, you're going to make money. You then have that other issue of, the delta as the stock moves from your long strike, you get long and short because this position is net long gamma. So the two motivations really, typically a big move in the underlying up or down or for an increase in implied volatility. Let's take one example. We got XYZ, our favorite underlying, of course, at the OIC is XYZ. We got a $50 stock. We decided to buy the Jan 50, so we're going to buy the call and the put. You can see the two prices. I don't pay any attention to the two prices, okay? I pay attention to one thing. That's the net debit, $6.20. Because what I want to know in my mind, there's so many numbers in the option space. The fewer I have to keep in my brain, the better. And so I don't care that I paid $3.20 for the call and bought the put for $3. I care that my debit is $6.20. I'm buying the 50 strike for basically $6.20. And I haven't specified how much time to January. It's really not important in our conceptual discussion of the straddle. What's important is you understand you're long the strike, the call and the put. So stock's at $50, we bought the at the money straddle. How much do you think that underlying needs to move at expiration for you just to break even? Well, let's go through it. That looks like the answer to me, upside and downside. Again, we're long a call, we're long a put. So as the stock goes up, the call increases in value, the put decreases in value. So that call is gaining value, gaining delta as well. And so as the stock moves from the strike, in order to calculate our break-evens, we take that strike price of 50, and again, going all the way to expiration, we take the 50 strike plus the 620, we break even to the upside at 56.20. To the downside, it's going to be the strike price minus the 620, or 43.80. So that's break even. The risk in the long straddle is the options decaying away to potentially nothing. I mean, worst case scenario would be we buy this thing, the stock moves around, but we're looking for this big move. We decide, not to hedge, not to sell it. We take it all the way to expiration. Stock goes out at 50 at expiration. It's the worst case scenario. We're losing $620 for every straddle we own. That's a horrifying thought. Hopefully, none of us put on any position where we put it on for something and ride it into the ground, where it has no value at all. A typical approach with a straddle is to buy it, looking for that big move in the underlying, having a specific time frame. If we get beyond that time frame, boom, you get out. The other motivation was, of course, an increase in the implied volatility. Same, discipline, I hope. Have a specific time frame. If it doesn't happen within that time frame, get out. I talked about, option volume. Average daily option volume in the industry is 16.5 million contracts a day. North of 75% of option contracts that are put on are closed out before expiration. So more than 3 out of 4 contracts are closed well before expiration. So there's the straddle. If the stock, if your plan is to hold this thing all the way to expiration, it better not go out at 50. You can see, I hope it makes sense to you, at 55, you lose $1.20 or $120, because at 55, the 50 call, the right to buy stock at 50 with a stock 55, is worth $5. The 50 put, the right to sell stock at 50 with the stock at 55 is 0. So you've got $5 of value in the long call or the straddle. You paid $620, so you're down $120. On the flip side, at 45, the value of the put, the right to sell stock at 50, is worth $5. The 50 call, the right to buy stock at 50, of course, has no value. So same scenario, just that the put's worth $5, the call's worth nothing. So you paid $620 for the straddle, you're out $120. Beyond, and this is where the fun begins, beyond 56.20 and 43.80, you're making money. And our example only takes us to 60 and 40. Significant moves certainly in the underlying, but if that stock went to 65, we'd be up another $5. So we'd be up $880 to the upside, and at 35 we'd be up $880 to the downside. So, in a high-flying, fast-moving, underlying, straddles make sense, but in a high-flying, fast-moving underlying, premiums will be expensive. So here's just another way to look at it. Your break-even points at expiration. Again, a discipline, hopefully, is if you're going to get into a position like this, you have a specific period of time or level of implied that you're looking for in terms of that movement. If you don't get that in a specific period of time, either hedge the long straddle, maybe by selling some options around it, or just get out of the straddle. So that's the long straddle. Long strangle, very similar in terms of what we're looking for. The difference being, and you can see that the P&L graph is significantly different. You've got a wider range, and that's because, yes, we're buying a call and we're buying a put, but the call comes from an out-of-the-money strike, and the put comes from an out-of-the-money put. put strike. Both options, of course, same underlying stock, same expiration. Again, motivations for an increase in implied volatility. And another consideration in the Strangle is that because you're buying out of the money options rather than the at the money options, the price of that straddle will be less. So again, same XYZ, $50 stock, the out of the money call, $55, the out of the money put, the 45 put. Again, we paid $1.40, we paid $1.05. Don't really care about that. I care about my total debit, $2.45. How does that look? So you don't take the price of the underlying, you take the strike prices. So the 55 on the call side, 45 on the put side, and you add or subtract the debit. So we take 55 on the call side plus the 245 takes us to 57.45 is our break even. On the put side, it's the 45 strike minus the 245 debit takes us to that 42.55 break even point. We're a loser in between, but again, that's the expiration. Hopefully, if what you're looking for doesn't happen, you're getting out long before expiration and you're getting back hopefully a significant portion of that 245 that you put out originally. To the upside, beyond those break-evens, it's nothing but profit. So again, two motivations, a big move in the underlying or a move in implied volatility to the upside, which would help to expand the value of both the call and the put. Difference between the straddles and strangles. Straddles, we're basically talking, for the most part, at the money options. They cost more, less leverage because you're tying up more capital, but chances are less chance to lose 100% if you're holding to expiration because how likely is it that at some point in the future that stock is going to be exactly at the strike price, not so high. Strangles, on the other hand, lower costs, more leverage because you don't tie up as much capital. If you hold the expiration, because the break-even point is a wider range, more chance to lose 100%. The enemy is time decay. If those underlyings don't move and the implieds don't increase, that daily decay is obviously going to eat away at your position. So that's straddles and strangles. I hope, prefacing with the background of the importance of implied volatility versus historic volatility gives you a little more clarity to the risk of the straddle and strangle. Let's briefly, we can talk about, because after all, this was a presentation for bulls and bears. Why don't we talk real quick about a couple vertical spreads before I turn it back over to Joe. Vertical spreads can be call spreads or put spreads. On the debit side, obviously you're going to pay to initiate that spread. On the credit spread side, we collect. And I think that's some of the strategy types in addition to the straddles and strangles that the group at Schaeffer likes to focus on. So let's, one of the great things about vertical spreads, and I do like them a great deal, is the defined risk in both spreads. Let's start with the call credit spread. So just, again, common sense. We're talking calls. We're talking a credit spread. So we're clearly going to sell one option that's more valuable than the option we buy. Investor motivation, capture some or all of the credit received when we take in the spread. The example, XYZ trading at 88.50. Here's our outlook. We think the stock should be lower or unchanged over the next month or so. But we don't expect the stock to move above 90, at expiration. So that being the case, we're neutral to slightly bearish. Choices, we could sell 100 shares short. Well, that's going to tie up a ton of capital. It's got unlimited risk potential. Bad choice. Sell a naked call. Okay, possible. In my mind, definitely, not the best choice. Again, going back to risk. Unlimited risk, not good. High margin. Yes, you do need broker approval and all those things. selling a call credit spread. Broker approval, you should have for sure, but let's go through it. And, this is why I think it's such a good choice. Again, we're looking for the stock, which is 88.50, not to really head north of 90, maybe head south. So we feel somewhat comfortable. Again, that whole aspect of what strike, what month. Because of our opinion, we don't think the stock's going to move much above 90 over the next month. We feel somewhat comfortable selling the 90 strike. That's good. But we got to buy a hedge. We turn around and buy the 95 call. Potentially we could buy the 100 call, and instead of doing a $5 vertical, we do a $10 vertical. But we'd, of course, have, more risk. So before I move the slides, net credit. Again, I don't care about those two individual prices. My net credit's it's $1.70. All right, so let's think through risk-wise before I move the slides. How much can I make selling this credit spread? Well, hopefully you said $1.70. You can't make a dime more or a penny more than what you sell it for. Your net credit's $1.70. We can make up to $1.70 or $170. How much can we lose? How do we figure that out? Well, the difference between the strikes. That's why we're not just selling a 90 call. We're turning around and buying the 95 call to hedge ourselves, just in case we're wrong and XYZ takes off. So let's see, the difference between the strikes is $5. Okay. We're taking in $1.90. The difference between the strikes is $5. So we take that difference, the $5, minus the $1.70. We know we can lose up to $330 or $330 for each one of these spreads. Okay, that's our maximum loss. It's double what we take in, but bottom line is we don't think the stock's going north of 90. We think it's 88.50 or lower over the next month. That's why we're putting on this spread. Again, I mentioned, you could turn around and buy the 100 call. Well, clearly, if you bought the 100 call, you'd take in a larger credit, but you'd have an additional $5 more of risk. So they're the choices, with the call credit spread. It's a bearish spread. Again, maximum gain is what we sell it for. Maximum risk is the difference between the strikes, less the credit we take in. Margin we put up is going to have to be that $330. Break even. The short strike plus the premium pay or taken in. So it's the 90 plus the 170. Above 90, 170 at expiration, we begin to lose money, but we know we can only lose the 330. What's the spread worth with stock at 88.50 in 21 days and 7 days? Well, it's certainly going to be less. So it's going to be something much closer to zero just a few days before expiration. So, that's the call credit spread. I hope you grasp the concept of that. One more quickie before I turn it over to Joe. The put credit spread, investor motivation, again, to capture some or all of the credit received. Stock trading at 88.50. We think the stock's going to be higher, not lower, and we don't expect it to trade below 85. So here we go. We could buy 100 shares, put up $8,850, tie up a lot of margin. We could sell the put naked. That gives us $8,850 of risk in case the stock, gets crushed. Or we could turn around and sell the put credit spread. So we don't think the stock's going below 85. We sell the 85, buy the 80. Exact same concepts as with the call credit spread. Maximum gain is what we take in, the 135. Maximum risk is going to be the difference between the strikes minus that potential credit. So that's 365. Break even to the downside is going to be that short strike, 85 minus the 135 takes us to 83.65. So again, you can go through the position simulators to figure out, what's the spread worth with 21 days left with the stock 88.50, with 7 days left. Lots of wonderful tools at optionseducation.org as well as Schaeffer's to check out that kind of thing. So, Same concept as we talked about with the call credit spread. You're trying to basically take in some of the premium in the marketplace over a certain period of time. So, Joe, I'll turn it over to you again. If folks are interested in some of the offerings that we have, our website is optionseducation.org. I also have colleagues Ed, Bill, and Mark who man the options services desk 5 days a week. You can reach out to them at options at the OCC 5 days a week, both when the markets are open or before and after the markets. I think it's an hour on either side. We got lots of stuff on YouTube, all the Facebook jazz, and please check us out. We do lots of webinars as well. So, Joe, I think we're right up to 1 hour.
Yes, and thanks again to Joe, speaking on behalf of Schaeffer's Investment Research. We appreciate your time and the presentation. And yeah, please be sure to visit the OIC and related channels there. And thank you all for attending.